Good afternoon, everyone. Welcome to our March 2023 monthly conference call. Thank you for joining us today. This is Jeff Hibbeler along with Randy Farina. Again, before we get started, I'd like to remind you to please send in any questions or comments to info@essentialwealth.com, and we will address these toward the end of today's call. So it's been a while since our last monthly call. We had the January webinar toward the end of January that we hope that many of you were able to attend. And a lot has happened in the time since that webinar. But as the saying goes, the more things change, the more they stay the same. Equity markets are almost exactly in the middle of the trading range since our last call in December. And if you're looking at the S&P 500, it's very close to where it was at that call 3 months ago. On the other hand, bond market yields have moved higher. They're closer to the October yield highs than the lows in January. This is largely the result of the economy showing resiliency and inflation looking possibly more stubborn than it was toward the end of last year and early this year. So while markets have moved, and meaningfully in some cases, the primary underlying drivers have really remained the same in our view, and that's inflation and Federal Reserve policy. So as luck would have it, talking about the Fed Chair Jerome Powell has begun his semi-annual testimony to Congress today, as what used to be known as the Humphrey Hawkins testimony. And speaking of hawkish, his initial comments today seem to be on the hawkish side. He made some comments that the Fed rate peak is likely to be higher than they had previously expected, and that was as of last December. And also the Fed's prepared to speed up hikes if needed. They had downshifted the last meeting to a 25 basis point hike from prior paces of 50 and 75. So I think this all falls under the fact that the Fed has been saying this for a while, but they continue to be data dependent. And while data started to soften some toward the end of last year, this year's data on the whole has been stronger. I do think the Fed is getting closer to the end of its hiking cycle, but markets had seemed to have gotten ahead of themselves earlier this year and were pricing in cuts toward the end of 2023. So once the Fed pauses hiking, we think likely they'll be on hold well into 2024. And the markets now are getting closer to this view. So Randy, we all know how much equity managers like talking about the Fed, but they've continued to hike and tighten policy. How do you see this affecting equity markets, and in particular, I was thinking about the equity risk premium?
Sure. Let's just break it down into the first question. How does it affect equity markets? Similarly to the fixed income markets, there's been volatility over the last 12 plus months, given a lot of the uncertain path of rates, the economy, and then you can throw in even geopolitical, Ukraine war, China, I guess not confrontation, but more tension over the last 6 to 9 months than there was a couple of years ago before the trade war. So the equity markets continue to be choppy. It is a situation where it's a rare companies have a signal well before a potential recession. So you are seeing some layoffs in certain segments of the economy that definitely overhired in hindsight, tech, communications being the main culprits. So, as many negatives as there always seems to be when whether you watch CNBC or open the Wall Street Journal or, the professionals look at Bloomberg daily, I would say that most of the headlines cater to negativity, as that sells, but there is also some positives down the road in that, again, the companies are getting a head start potentially on right sizing or looking at cost structures before a recession, whereas usually it's when the slowdown has already hit, they're starting to react and cut costs. So, the question about equity markets, the outlook continues to be a data dependent, just as the Fed is, just as the bond market is, just as everyone is. So it's hard to make big sector bets or big even stock bets in our portfolio at the moment, given this outlook. So we're trying to be diversified, use opportunities as we see some stocks either price in too much optimism or price in too much pessimism, and we trade around that. So, from the investment team, the equity portfolio managers, Pete Trontis and myself, our approach during this period has been and will continue to be a little bit of a defensive posturing across all of the portfolios, more cash than I would say normal, and trying to be opportunistic on our trading. So we have probably traded more this year than the start of this year than we did at the start of last year. Answer the second part of your question on the equity risk premium. Increased interest rates definitely would increase the WACC or cost of capital for companies in the market. And I guess you can say that that's the equity risk premium, but in general, the WACC is both the risk-free rate plus the equity risk premium. And the equity risk premium is really driven by more of a function of longer term volatility, longer term growth of the economy, in the spread, the returns that you'll get over equity over bonds. And that historically has been 4 to 5, and risk-frees have averaged 3 to 4 over time, other than the last decade when they've been under 2. So I don't think, to be honest, Jeff, I know everyone says the equity risk premium is heading up. I think it's more in line with its longer run than not. I'll leave it there.
Okay. Yeah. Thank you. Yeah. And, I want to piggyback on your comments a little bit on the employment. You said some sectors, maybe they overhired and they're starting to maybe right size. And, on the tech side, or they maybe projected growth a bit into the future and tried to, scale up for that. But, something I was seeing the other day, and tying this back to kind of the Fed and thoughts on why they'll probably be on, be holding a higher terminal rate for longer, is there's a structural, lack of job seekers in the economy. And saw a really interesting chart. It started the undersupply, I guess, of job seekers compared to available jobs really started a little bit before the pandemic, kind of end of 2017, 2018. We remember unemployment got really low then. Then, of course, the pandemic hit, things went haywire, for lack of a better term. And then as we've been coming out of it and, economy stabilizing and doing better, it's really amplified. And certainly the pandemic caused a lot of employment dislocations. But one thing that has persisted solidly for the last at least year is, just what Powell calls the labor, supply demand imbalance. And as that continues, and if it continues, and it's so large that it probably will, it's inflation kind of stays stickier, wage gains potentially stay higher, depending how productivity goes in the economy, and takes longer to come down. So, those are kind of longer term, structural things, but something behind my thought of why they'll want to be, at a higher rate for longer.
Yeah, that's all fair. And I guess, to take that to the next step. What does a higher rate for longer mean? How does it impact stocks? How does it impact companies hiring or companies trying to grow and gain market share and, you know, just run their business? To be honest, I would say not much. I mean, the market companies, corporate CFOs will adjust to the interest rates. Their cost of funding has gone up for debt for sure. That will be taken into account as they start to plan projects for the future and capital expenditures and whatnot. I honestly don't think there's a massive impact in S&P 500 companies, because a lot of them are very fully funded, strong cash flow, and no balance sheet issues. It's, I guess, the non-S&P 500 companies that this will take more of an impact on. Smaller companies, business formation. The cost of capital has certainly gone up because debt costs have gone up. So that could slow the economy, which is exactly what the Fed wants. So this higher for longer should either manifest itself into a recession or a significant slowdown in growth. It doesn't necessarily have to be a recession. It could just be a slower growth environment for a number of years. So that is the waiting game both the market and the Fed is playing. You know, as you mentioned, I think in your opening comments, about rate cuts were expected at one point, and now that's off the table. No idea if the markets were pricing that in or not. Sure, the future curve showed that, but whether the stock market priced it in, we're still at the same level in December as we are today. So it's hard to say, you know, what one factor is ever being priced into the markets. But this waiting game of slower economy, stronger for longer, recession is kind of what we're dealing with. But don't forget, companies are continuing to, you know, move ahead. Most of the companies we have invested in have been around since 2008. They've already gone through a significant, you know, financial crisis, which this is not, nor do I think it will be. But those are the factors that companies have to take into consideration as they make their plans, and as investors, we have to try to factor all that in. But it's a long waiting game that is tiresome for us professionals, and you know, probably for clients as well, because everyone's just waiting for either this clearing event. You know, market goes down and no one wants to see that, but there's your clearing event, or we don't have a recession or a slowdown and we just kind of absorb these rates. Again, time will tell. It's a difficult period to navigate. It's not unprecedented. I've had other events, 9/11, dot-com bubble, GFC, and COVID, that are more unprecedented in scale. I don't put this up there, but it's just a continual daily, I guess, focus of the market. And maybe it shouldn't be. We can talk about that after, but
Yeah.
Go ahead, Jeff.
Yeah, I was going to say, you know, a couple thoughts, you know, similarly across, you know, corporate, from the credit, from the fixed income side, you know, I echo your comments about really the strength of a lot of, at this point, companies, balance sheets, and fundamentals. And, you know, one thing from a debt side that has helped is, you know, revenues growth has still been pretty strong, you know, and inflation is playing a factor into that, but that has been a benefit so far that we're seeing. The other thing I would kind of also make a comment on, you know, higher rates and some, you know, it's a flow through effect. Something we've made a comment is that, you know, being at the ultra accommodative stance the Fed was at for a while wasn't really healthy. They felt it was needed. Maybe it was needed for a while, but it does create dislocations and mispricing of particular assets. And I think one of the themes from the investment team, you know, over the last year plus is maybe getting to a bit more normal monetary policy state. You know, it helps to allocate capital more effectively, more productively. So, in the long run, short run, it's not as enjoyable to go through. Long run, I think it keeps things healthier. But, Randy, you were talking about the markets, and, clearly a lot of cross currents in the equity markets, but, clearly everyone has their kind of bullish and bearish signs that they look for. And so I was curious, what are kind of things you're looking at, and what are you seeing currently with respect to those factors?
Sure. So I think the narrative in the market is that earnings will be down in 2023. 2022's EPS, came in around $220 a share. And you've seen estimates anywhere from 180 to 220 for the full year 2023. So there's no earnings growth this year. There's some companies that had earnings declines. Tech, as the second half rolled on in 2022, a lot of the semiconductor companies started to have a little bit of impact, Micron, Intel. Some of those are more structural than just overall market, but there was definitely a slowdown in PC and low-end handsets that impacted a lot of the semiconductor food chain. So those companies had earnings down in 2022, or at least the run rate in the second half. Those start to clear in the second half of this year. And then you have other companies that had strong earnings in 2022, like energy, that'll have down earnings in 2023. Earnings for energy companies will be lower in 2023. Just the oil price will average a lower, as we stand today at 80, it'll average a lower price than we had last year. So there's a lot of these sectors and industries are having a little bit of a different post-COVID earnings trajectory. You had, Target just completely have a earnings, not collapse, but their EBITDA was halved last year. So they did about the same level of sales, 110 billion. They went from 12 billion in EBITDA to 6+. So how do they get that back? They had to discount a lot of that. They had to clear inventory. They had the wrong stuff at the wrong time, is what they're saying. I do think they'll get back to their longer term margins, but it'll be a couple of years. You had a Home Depot that had a huge pull forward from COVID. They did 20% comps. Well, the way you look at retailers is they do comparative store growth year over year, or same store sales. Usually runs 3 to 4 for Home Depot. It ran 20% for 2 straight years. So how much home reconstruction, remodel, new build can happen? So their earnings now projected to be flat this year, but that's where we think the risk could be, that they could be down. So it's a very uneven economic cycle that is impacting companies across the board. So, what am I looking for was your question, in signs of, either a bullish or bearish stance on companies and sectors. It's really, our earnings near trough, and if so, that's fine. We can then start to price what the recovery will look like, and the market will always price the recovery before the earnings trough. It's just that you want to get a sense that they're within a quarter of 2. And then on the other side, companies that have continued to have strong earnings, like airlines, service-related companies, travel companies, when will that start to, slow, given the potential for an economic slowdown in the second half, or now we're talking first half of 2024. So that needs to be calibrated into the stock prices and the future cash flows out a couple of years. So it's, the signs are the companies and industries earnings near trough, and if they're on the other side, are they a quarter or 2 from peak? And then that'll help us position the portfolio. So really, Jeff, long answer to a simple question: what are some of the bullish and bearish things I'm looking at? It's still very data dependent, just like the Fed on inflation and jobs. It's, quarterly earnings matter more now than probably they did in a normal environment. So we have to look for signs throughout the industries and throughout the food chains of companies to see, where we at. peak rolling, trough, at the trough. So those are kind of the two big things I'm looking at.
And following up on that, how does that affect, you talked some about sector positioning, and do you want to talk a little bit about kind of how all that's translating into sector positioning?
Sure. I mean, in the U.S. portfolio, well, really across both the core value and international portfolio, we've traded some of the semiconductor stocks this year because they've really bounced strongly off the October lows. And for the semi-cap equipment companies, they're just now, they had record revenues in 2022, record revenues. Fourth quarter for semi-cap equipment companies last year were the best ever. No one probably would think that, because the stocks went from, peaks in January to troughs in October to maybe recovering some of that by year end. But they're just now starting to enter a slowdown or a revenue contraction. And I think those stocks could be in for a little bit more volatility just on the semi-cap side. So we sold those and we trimmed some of our semis. We still think industrials are kind of fairly valued. We've been trimming some of those in value and core. In the industrial, where we still see value is in the travel, airline, aerospace, and defense. We see value there. Those are not fully valued to us. And on the defense and aerospace side, you still have the trajectory of a recovery in that, because you're still not back to 2019 run rates for delivery of airplanes. And then on the defense side, unfortunately the war in Ukraine and tension with China has kind of ratcheted up budgets globally. So there's some tailwind. But a lot of the US names are more fairly valued on the defense side. We've been looking at the European names for the international fund. We don't like the material sector. I think, yes, China is reopening, COVID bounce, but I think a lot of the steel, iron ore, copper names have already discounted that. And we're a little worried there. On the energy side, again, prices will be lower in 2023. The backdrop of runaway energy prices kind of is off the table. The warm winter in Europe and in the US definitely has alleviated the concern for this cycle, or let me rephrase that, has alleviated the concern for this winter. The LNG exports in Europe, the import terminals that were built in Germany in record time, they thought it would take 3 years. It took 5 months. That helped as well. So the Russian oil, or Russian really natural gas, that was so critical to Europe, they kind of have turned that now to their advantage, in that they have and will wean themselves off Russians, the dependence on Russia for natural gas. So that puts Russia at a disadvantage over the longer term. So that's good. And again, some of the tech, we like, the larger cap tech names that got hit last year, like Meta, Google. I still think they're in a good position for earnings recovery as you start to cut costs on. They were the poster childs for hiring too many people too fast, and they are now right-sizing their ship. So they're ahead of a potential recession, of adjusting their cost structure into it. And consumer, that's kind of a wild card, to be honest. Consumer discretionary home. If you look at the housing cycle, I mean, interest rates are near 7 now for, if you want to go get a 30-year fixed and buy a house. Nobody remembers that. I mean, that was in the mid 2000s when rates were back this high. So that's definitely impacting inventory, new home construction, which then feeds into remodel, refurbish, furniture, everything in the food chain. So that's a wild card that market knows that. So the PEs and the stock prices are way off their highs. Some of them way off their lows now too, though. So it's still, that is the most trickiest one to navigate, to be honest with you, because I don't know how housing behaves over the next 12 to 18 months. So again, it's all about valuation, what's priced in and what the earnings trajectory are and what the longer term opportunities are for companies. Some will fail, some will take share and win. So that all gets factored in as well. So that's a summary of the sectors, I guess.
Yeah, that's excellent, Raina. That's a very helpful summary. Really interesting hearing the thoughts of what's kind of going on into the portfolio construction. And yeah, couple questions we have, thought we'd roll into those. One question we've gotten a fair amount lately is, and it's fixed income. Really, it's well known the yield curve is inverted. If you're looking at just treasuries, the highest yields are on the very front end of the yield curve compared to longer maturities. And question that pops up is basically like positioning. Should from clients, should we be in just shorter term bonds, or should we own any longer term bonds? And it can be somewhat of a difficult question because there's a lot of factors that are client specific that go into it, and certainly for folks that have short-term liquidity needs or looking to make possibly major changes, it makes sense to have some in the shorter maturities. But I would say, in general, when we're constructing our fixed income ladders, that long-term exposure is an important part of a person's overall portfolio and allocation. And a couple things go into that. One, that at some point in the future, short-term rates will fall. We've been in here a pattern of the last 15, 18 months where they've been rising, but they will fall at some point. Could be very unexpected, depending of the economic and monetary climate. And so having some of that exposure in the longer part of the yield curve kind of helps to lock in over long periods when rates could fall. The other thing is that in particular environments, whether it's maybe market stress or again, you've got rate cuts and yields fall, prices go up, there's more price appreciation in those longer maturities. And if again folks are making asset allocation changes, and some of those gains can be realized at that time in the future. And something, Randy, that you mentioned, kind of with the defense industry, and global conflict is increasing, and that's not really I guess that's an obvious statement, but something for me as a fixed income manager, with those conflicts increasing, it makes me want to have some exposure in somewhat longer maturities in the yield curve as some hedges to adverse events that could be resulted in conflict. So that also kind of rolls into another question we received. It was, given the state of the markets and just kind of overall uncertainty in them, what is our strategy to harvest equity losses and invest in maybe fixed income or other strategies until that uncertainty and volatility subsides? And with our equity strategies, we do, and I'll let you talk about this in a minute, Randy, in more detail. We do occasionally do some tax loss harvesting in those equity strategies, and I think it's more on an opportunistic basis when we adjust them. But in general, rotating between asset classes is an asset allocation decision, and really that's driven by our advisors, who are the quarterback of the relationship, and tailoring those asset allocations to each client's unique circumstances and risk reward requirements. So, Randy, I turn it back to you if you have any
sure.
follow-on thoughts.
Yeah, I was a lineman in high school, so I didn't get to play the quarterback role. So I'll just plow ahead, try to clear that field so someone can get all the glory. That's what the equity guys do, I guess, right, Jeff?
Yes.
Anyway, I
Yes.
do want a lot of, you know, clients, advisors, even friends, you know, hey, why should I have money in equity? I can go get 4% in the bond market, you know. Okay, great. But if your goal is, again, if you need money, if you need your money out of your investments in the next couple of years, you shouldn't have it in equities anyway. You should have that, you know, either in cash or in very short-term vehicles. You know, this is something you work with your advisor. But even I, you know this. I'm just not an equity guy picking stocks. I'm, you know, been around markets long enough to know how you should be allocated across. But everyone's risk tolerance is different as well. So there's that element of it. But if we're looking 10, 20, 30 years down the road for your savings for either college, retirement, et cetera, you need equities. Let's not kid ourselves that 4% is this being blown away by the 4% that fixed income is offering. It's against the 1% we had the last decade. But over the long run, 4% has been about, if I'm wrong, Jeff, let me know, 4% has been about the total return on fixed income investments. I'm talking decades here, where equities have offered more. So you need a combination of the two, whether you want to weight it 60, 40, 70, 30, 80, 20, and whatnot. That depends on your risk tolerance level. That's why you have an advisor. That's why you work with someone that knows your cash flow needs today and down the road. So in general, when someone asks me that question, I just say, sure, but you should have exposure to equities as well. Because I think equities are compelling, because over the long term, companies navigate around uncertainty. Uncertainty usually is the best time to invest, because that is when stocks are nearer levels of cheapness that they're typically not. So, you know, are we at that max uncertainty? No, but remember June and October, when the markets just kept falling every day, every month. Those were times where the fear overwhelmed, you know, pricing in the market. And, you know, we try to take advantage of that. But individuals should as well. You don't want to knee jerk and be too short-term focused on the next 12 or 18 months when really your goals are 20 and 30 years down the road. So again, it's all about the opportunities both across fixed income, across equities. If your risk tolerance is lower or higher, we have other, you know, core or defensive equity or equity income or international. We have the strategies that can help facilitate, you know, your desired expected return and risk tolerance. It's just really speaking with your advisor that can help guide you there. From my perspective, I'm just picking stocks within the strategies that we run, and I'm weighing them against other stocks. I'm not weighing my stock choices against the fixed income alternatives other than in the equity income fund. Because if I'm investing in the international stock fund, it's all about international stocks. It's not about what the fixed income opportunity I have in, because that's not going to be included in that international fund. So that's how I think about allocation, fixed income, and the different strategies, Jeff.
You know, I think kind of just wrapping it all together, you know, between the, you know, again, uncertainty, one could argue maybe there's a bit higher level right now than typical, you know, it's always, you know, an arguable point, and risks out there, and you know, Fed policy and, you know, market pricing. It you know, it speaks to us. I think our team has talked about this of having a balanced approach to investment allocations, not getting probably too far over the skis in one particular direction, but you know, essentially kind of spreading out, balancing risks, spreading it out, and then as you know, the market and events evolve, you know, if A, we're making changes in strategies to take advantage of those, but B, as maybe extremes get hit, then, you know, there's always opportunities to adjust the other factors as well. So at this point, we'll go ahead and conclude the call. We appreciate everyone joining us today and hope that you'll join us again next month on Tuesday, April 4th at 12 o'clock Eastern. Thanks again for joining us today, and we hope that everyone has a great rest of their week.